Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
So, Shauna, thank you for joining us. And by the way, because I apologize, I didn't mention, I consider Shauna a tax strategist. There's all kinds of tax accountants and tax preparers and tax planners, but a tax strategist is a means more because it is more. And this is definitely someone you want to know, Shauna, and also introduce to your clients. Because remember, often your clients are investing in real estate because they have, substantial wealth and income that they're looking to, not hide, but looking to deploy for the best outcome. And then taxes is always a big part of that. So, in any case, Shauna, hopefully I didn't that botch it up too well or too much, but I really appreciate you joining us again, and thanks for being here.
Oh, my pleasure. I'm thrilled to be here, guys. And so thank you so much for the warm welcome. I appreciate it. As Gary said, I love teaching. So one of the things I do have the webinar chat on the side open. As you guys have questions, please ask them. I'll try and answer as many questions as I can live as we're going through today and see what we can do, see what we can come up with to answer you guys' questions and give you hopefully some strategies that you can use with your clients, with yourself, as you're out and about in the world overarchingly. So thrilled to be here with you guys today. Just to double check, can you guys see? Just give me a thumbs up. Slides are good, nice and centered. You guys can see them. It's not okay. Sometimes I get told that they're way too big or way too small, so want to make sure you guys can see them. So figured I would start this slide deck that I have up today has well over 123 slides. We are not going to go through 123 slides in 1 hour. It's not going to happen. So what I wanted to do was kind of jump around to some of the big picture things, see what I think might be best based on the questions you guys have. Okay. Now, really, if we're specifically talking about retirement today, there are some things that will save you taxes that will give you cash to do retirement. Okay. For many people, they've been going along, they're fighting to make more money, make some more profit. But if you're not making more profit, you either make more income or you cut down on your expenses. And considering taxes is one of the largest expenses that most people have, saving those tax dollars and putting them in your own pocket for retirement or any other purpose for that matter is, at least in my opinion, one of the best things that you can possibly do. So you can see our cover slide here is talking specifically about some of the strategies, but some of the ones in here are specifically about retirement. So love to start off. Does anybody have any burning questions that I absolutely must answer in today's webinar? Anybody need anything in the chat? Anything you absolutely must know from a strategist? Okay, well, if you guys come up with them, throw them in the chat for me. I want to make sure that I'm covering as much as I can for you guys today. Okay. So a little bit of background here about me, just so you understand who's speaking if you weren't here the first time. I guess it's rounding up to about 25 years of experience at this point. I'm ex-Big Four accounting firms, so KPMG. And for any of you that are Jedi followers, right? We got to love some Star Wars. Can anybody guess who the dark side is when I talk about the dark side?
The IRS.
The IRS. I love it. I love it. Definitely, I've always called or considered myself a little bit of a tax Jedi, right? My job is to figure out the rules, help people use those rules legally above board to minimize the tax end. So I've been on Forbes. Entrepreneur is the one above. I've written a couple of books. So if anybody is looking for additional tax strategies beyond today and they want to read, this is the most recent book, The 6% Life. It's found on Amazon. Can anybody guess where that title came from? The 6% Life? So the 6% life, we actually get our clients, the average tax rate is 6.92%. So if you or your clients are paying more than 6.92%, there's definitely some tweaks, right? There's definitely some work that we can do to help reduce that. So I wanted to throw out a couple of big statistics here for you guys. Tax Goddess, on average, we save our clients 186.57 million per year. Now, many of you are looking at that going, wait a second, I don't pay 186.5. I wish I was paying 186.57 million per year. Okay. A big part of this, and this is where I'm really excited to deep dive in here with you guys today, is the retirement end. Okay. There's different ways to go about retirement specifically. So you have tax-free, completely, forever, for life, including in retirement. You have taxable retirement, which many of you maybe have heard, 401ks, IRAs, those kinds of things. You also...
Guys, let me give you the rest of it.
Oh, sorry, Heather, was that a question for me?
No, sorry.
All good. No problem at all. Okay. So we've got, completely tax-free for life. We have taxable when we get to retirement. We have tax-free as long as you die, which I'm pretty sure, no vampires in the room. We're all at some point gonna, okay. No vampires. Okay. All right. I have to change the conversation if one of those show up one day, but so really what we try to look at is, when we're looking at tax strategy, is not only how do we reduce your taxes today, but what is it that you're expecting in your life as you get closer to retirement, as you live through retirement and closer to death, right? So tax strategists generally will look at the big picture overarchingly for the next 10, 20, 30, 40, 50, 80, it depends on how many years you end up living from that standpoint. Now, really what we look at is what kinds of strategies are going to work best for you, all right? Every single person in this room has a different set of circumstances. Can I just see a raise of hands? How many people are married? We got a couple. All right. How many people have kids? Got a couple of those. Okay. So those two factors alone, if you're single with no kids or you're married with kids, your tax plan is completely different depending on your family circumstances. We will often look at or call this the chessboard, because if you can imagine, the IRS has a very specific set of rules, right? You're allowed to do this, you're not allowed to do this. And that works very similarly to a chess piece, right? The queen can move any way she wants, but the king can only go one direction. Right? So every single chess piece, every single fact that you have about your family and your situation will determine which tax strategies work for you and for your family and for your business. Okay. Love it. Okay. When is the right time to take Social Security for retirement? Oh, blessed. That's a big question. I'll try and see what I can do to cover it. Okay. But that one runs its own webinar all on its own. So we might have to come back to that one, but I'll try and answer as much as I can. Thank you for the question. Now, a couple of things here. One of the big questions that we get all the time, right? And Gary kind of alluded to this. Shauna, isn't this what my CPA already does for me? How many of you have gone to your CPA and said, I'm not happy with the amount of tax I'm paying. I'd like to reduce it. Has anybody ever asked their CPA that? Yeah, Andre, Gary. Okay, I'm getting a couple of nods, a couple of hands up here. Okay. And has your CPA told you to buy a new car or form a 401k? Yeah, I got a few. Andre's saying maybe. Andre, so tell me, what did your CPA say when you said, I want to reduce my taxes? What did they say?
When I first asked her, she told me to set up a S corp because I was just an LLC.
Perfect. That's a good suggestion, right? And that's one of the what we call the low-hanging fruit, right? Where many CPAs will say, okay, listen, I know the 5 to 10 basic strategies, right? Let's get a car, let's get a 401k, let's convert to an S corp, maybe let's get the kids on payroll, that kind of thing. All right. And that works fantastically, right? When you switched, Andre, from an LLC to an S corp, you probably saved about, 15%, 16% on 70% of your income would be my bet. Yeah.
It's probably pretty close. Yeah.
Probably pretty close. That's a good chunk of savings, right? And Andre, just to make my numbers easy, okay, let's say that was $100,000 of net profit. 70% of that is 70 grand at 15%, right? We're talking a little over $10,000 to $14,000 a year. That's some pretty good savings, right? That's good stuff. one of the things that I love about tax strategy is that you can apply multiple strategies to the same person, to the same business, to the same world. So just because Andre is now an S Corp does not mean that he could not also do, for example, a medical expense reimbursement program, or paying the kids, paying the grandkids, writing off the dogs, okay? There's a million different ways to slice the tax strategy game, and it's all custom based on what you want, okay? Now, one of my favorite stories, which is how it made it on the slide, does anybody in here want to buy $1 million yacht? I got one smile from Lily here. I think maybe. Gary raised his hand. Maybe, okay?
Mm-hmm.
We can even help you write off buying a yacht, okay? This was one of my favorite cases. Client called the office, right? Prospect at the time called the office and said, I want to write off a yacht. How do I write off a yacht? And at the time I answered the phone and I said, well, hi, my name is Shauna. What's your name? Hadn't even introduced himself yet, right? He was so focused on getting that yacht, okay? Every single above board legal thing that you want to do can be handled within the tax code. You just have to figure out how to do it. And I think that's really where the creativity and the fun of tax strategy comes in. And I know a lot of people, I'm like kind of watching Lily's face here because she's expressive, right? And like, fun, tax strategy. I'll believe it when I see it. We'll see how today goes. So, okay. Now, we talked about the chessboard. Would you guys mind giving me a little bit of understanding? So I know in the room, right, all of you guys own businesses, you're all looking at this. Can you give me a little bit of understanding? Who's single? Who's married? We got hands up. Does anybody have dogs? Do you guys have rental properties? Can you kind of give me some notes in the webinar chat just so I can tailor today's presentation for you guys?
Yeah, guys, go ahead and type in the chat, like single, no kids, married, 2 kids, that kind of thing. Single, how about grown kids?
Yeah, grown kids versus young ones, grandkids would be helpful for me to know, those kinds of things. Married, 2 kids, 2 dogs. Got it. Married, grown-up kids in a rental property. All right, Gabriella, awesome. Okay, 3 young kids, investment property. Single, no kids, no pets. Okay. 1 dog. Married. 27, 8 granddaughter, 2 dogs. Okay. So this is kind of what I meant, guys, right? Where you have different people with different pieces on the chessboard. So as we go through today, I'd love you guys to be asking me questions with your own situation in mind. And of course, as Gary said, if you have clients from that standpoint that you can think of where these things apply, 5 vacant properties. Oh, blessed. Ouch. Okay, that's a tough one, right? That's especially tough if, if the cash flow isn't coming in, how do you get the cash flow to come in, right? Okay, I love it. Thank you for sharing, guys. This is great. All right. So one other piece that I want you to understand here, when you're looking at a standard CPA versus a strategist, okay, there are levels. Now, I am a CPA. According to Google, there are 660,000 CPAs in the entire US. There are 60,000 that have masters in taxation. And as you start going up this kind of pyramid of specialization, all right, CTC, CTP, and CTS, there's only 15 people in the entire country that do what I do, all right? So you've been, from that standpoint, very lucky. Gary was able to rope me in to come talk to you guys. I love educating from that standpoint. So I'm very excited to be here with you guys. So please ask those questions because today is the day to get your answers, all right? Whichever way we're looking at it. All right. Now, this is probably my favorite question out of the entirety of this presentation, okay? The aggression scale, 0 to 10. Now, this is something that you guys may already be asking your clients, but in a different format, in a different way, okay? For tax strategies specifically, 0 to 10, the scale means 0, the IRS never calls you never ever, but you're leaving money on the table. She doesn't look very happy, right? All the money's gone. 10, meaning we're all going to jail. Does anybody in here want to go to jail? Like, no, I don't know. Not normally the thing you want to be even discussing when it comes to taxes, all right? So the way that Tax Goddess looks at this scale is we say, listen, 0 to 10, 10 is we're going to jail. 9 is we're doing shady stuff, hoping we don't get caught. We're pulling an Al Capone, right? So shady stuff, many people don't want to go that far. We really look at the scale from 0 to 8. 8 means the IRS might call you, but you have all the backup, all the documents, all the T's are crossed, all the I's are dotted. And so the IRS comes in and they look at it and they say, okay, and they go away. So yeah, Andre's saying, yeah, I'm an 8, right? Every single person in this room needs to decide, well, where are they and where is their spouse, right? So for those of you that are single, right, you get to make that choice. So if you're an 8, if you're a 2, if you're a 6, whatever that is, you can choose to look at any given tax strategy through that lens, right? If you're married, we often have cases where, you know, one spouse is the entrepreneur and they're pulling for like 8.5. They want to go super risky. And the other spouse is like a W-2 and they want to be at a level 0. Okay. So if you're in a blended family, you definitely need to know, you need to understand, well, what is that aggression level for everyone that's in the family? Everyone's signing the tax return. And I love it because I'm seeing Andre. I can only almost picture him texting his wife going, okay, are you a 0, a 10, a 7, a 2? Like, what are you on the scale? I love it, Andre. Thank you for the participation. I dig it. Okay. So for each of you in here, can I get an idea? Where do you guys think you sit? So 0 to 10, 0 meaning the IRS never calls, never ever. 10 meaning we're all going to jail. 8 is it's legal, but you might get a call. Where do you guys think you sit on that scale? So I can kind of judge which strategies to cover today. We got a 6. All right. Love it. We got a 2. Thank you. I appreciate the honesty. Okay. We'll make sure to cover some 2 strategies. We got a 6.
And I have been audited on a couple of some more minor questions over the years, like every couple of years. But one was a major audit when I had I had a large building that I sold, and of course I knew it was going to trigger an audit. It took an entire year. It was a little bit costly in time, energy, and money. I was traveling at the time constantly, so I had to pay people that work for me to gather information, things like that. My tax accountant, thank goodness, was kind of leading the charge from where he was. But in any case, at the end of the year, it was a net 0 changes. Said we're satisfied. Thank you for cooperation, and because we had everything, all the documentation all lined up.
And that's what it is, guys, right? That's why I call it crossing the T's and dotting the I's. Because if you don't document whichever strategy you're going to use, and they come to talk to you, which is, so it's like a twofold path here, right? They have to come look at you, and you don't have documentation for you to lose out here. So I really appreciate, guys. Thank you. The overwhelming majority of you guys are 6, but we got a 2 and we got an 8. So perfect. So we're going to cover the spectrum today. And as we get to a strategy, if you want to know what level that particular strategy is, just ask. All right. I'll throw that answer in as we're going through them today. So perfect. All right. Now, excuse me. We got a 7. I love it. I want to get into some tax strategies. Okay. And the tax strategies are going to cover actual tax strategies. They're also going to cover some of the retirement options, these kinds of things. All right. So the very first one, because I know we had a lot of people talking about kids. Okay. Writing off children. Now, this also works with grandchildren. Okay. The first place to start. So those of you, because I think we had an 8-year-old granddaughter I saw, Jessica had 3 young kids. The very first cutoff is whether they are 7 years old or not. All right. So if they're at least 7 years old, you are allowed to hire them to do work for your business. All right. Now, the maximum amount that you can hire somebody for is whatever fair market value is for the job. So for example, if you've got a 7-year-old emptying waste paper baskets and doing the shredding, right, you might be able to pay them $20 an hour. Right? That's if you hired a janitor, if you hired a secretary to sit and shred for you, probably somewhere in that range, $20 an hour. As the children get older, right? So now they're 14, 15, 16, and they really understand SEO and Twitter and Instagram and, these kinds of things. You can pay them whatever the fair market value is for a marketing person. Okay. Marketing people, at least in my area, I'm in Phoenix, I'm in Paradise Valley, Arizona. In my area, marketing people get paid $130 an hour. It's a big difference to $20 an hour for emptying trash cans. Okay. Now, the maximum dollar amount that we talk about when we pay kids, and this year for 2025, we're generally running about $22,000 per child. So if you've got, I think it was 3 kids, Jessica, right? You could be writing off $66,000 a year. Okay. Now that money, the one thing you have to know is that money belongs to the children, belongs to the kids. And so we often get this question of, okay, well, great, I've paid the kids, but now they're going to go buy a Ferrari, right? They've got huge chunks of money. They're going to go buy their first car and they're going to spend it all. Kids, it's their money, but they don't need to know they're getting paid to do the job. Okay. What a lot of my parents will do, and this is the first kind of area retirement comes in, not for you, but for the family, right? Generally, we try to build family wealth. This money can be put into a traditional IRA. So if you put that $7,000 into a traditional IRA and the $15,000 base for the child, it's $22,000 completely tax-free. So if you are, Jessica, you read my mind, we're going to come to that, okay? If you were already paying for things that are not the 3 basic requirements, okay? There are only 3 things that you cannot use this money for, all right? So you cannot use it for food, clothing, or shelter. Food, clothing, or shelter. But Jessica, to your point in the chat, can you use it for school tuition? Yes, you can. Can you use it for the iPad that they need to do their homework? Yes, you can. Can you use it for a down payment or to purchase a first car? Yes, you can. All right. So a lot of parents are paying for these things out of pocket, right? You're paying for your 16-year-old's insurance and your insurance just went up $10,000 because they got into an accident, whatever it is, right? These are things that the child's money can pay for. So anything other than food, clothing, and shelter, you're good. All right. Now, some parents decide, you know what? I don't want to use that money. I have enough money. I'm going to continue to use, my money to pay for those kinds of things. This money can also be invested. All right. So you can put it into stocks. You can buy options with it. You can put it into QQQ stock, like whatever it is that you feel would be a good investment on behalf of the children. This is setting up the kids for future success, right? Especially if they don't know about it and they don't spend it on that first Ferrari, right? So, okay. Now, the other note that you'll notice at the bottom, if your business, so Andre, is it okay if I pick on you today because you gave me a little detail about the S Corp? Yeah?
Mm-hmm.
Dig it.
Sure.
Okay. Thank you. I appreciate it. Ah, you're good at picking. I love it. Okay. So, if Andre has his kids or his grandkids working in the business for him, and the business has a 401k plan, or has a defined benefit plan, or has a SEP IRA plan, okay? He can also put money on top of these wages into the kids' accounts, right? Because, for example, with a 401k, you could do a profit sharing portion out of the business, all right? So as your revenue, as your net profit gets bigger and you're trying to find ways to shelter this money, if you were going to give the kids Christmas presents, give them a 401k match instead. So there's options here. Okay. Love it. All right. So guys, ask me questions if you have questions. Otherwise, I'm just going to keep rolling. Okay. Now, the next thing that I want to go to is the different kinds of retirement. Okay. Now, there are a lot of traditional retirements, and so I'll do my best to answer your Social Security questions. Okay. I'll tell you right now, I'm not an expert in Social Security. I know a guy. We can get him here with Gary, with you guys, talk about Social Security if you want that as a presentation. But there are in my mind, there's 2 types of main retirement plans. All right. There's the taxable kind and there's the non-taxable kind. Okay. Now, many of you have heard maybe of a traditional IRA versus a Roth IRA. Is that, yeah? Okay. Yeah. Perfect. All right. So all of the retirement plans can have traditional versions and Roth versions. And so you have what are called qualified plans, things like your 401k, your SEP, your standard IRA, your simple IRA, okay? And then you have non-qualified plans, which are often not tax deductible. So you're putting money aside, you let it grow, but it's often not a tax deduction. So one of the biggest ones, can I get an idea, guys, in the chat for me? If you wanted to put money away into retirement, how much money are you talking per year? 10,000, 30,000, 100,000, 500,000? What's an idea of how much money you would want to put in that you have cash flow for? $30K, $60K? Okay. Okay, got it. All right. So when you look at, if I use those two as our example numbers, the 30K and the 60K, okay? If you look at, for example, a 401k, the current maximums for 2025 for a 401k, if you bulk it out, if you do everything inside the 401k, is about 65,000, depending on your age. Okay, all of these plans change, the dollar limits change based on your age. All right. If you were looking, let's say you were looking more at 7,000, 10,000, you would start with your traditional IRA or your Roth IRA. Okay. As you go up, the SEP and simple are typically a percentage of whatever your profit is. Can anyone guess what the problem is with doing a percentage of your profit if you're using tax strategies?
Well, profit, I wouldn't identify that as being the same as earned income. And I think most retirement plans, aren't they based on earned income?
Yeah, and so it's an excellent question. So unfortunately, good or bad, if you're using tax strategies, so let's say, Jessica, we've paid your 3 kids, right? Your profit, your earned income, the net amount that the IRS would normally have taxed, right? Let's say your net amount was 80, right? So in a SEP, for example, normally you can put away 25%. So 25% of 80, 20 grand. It's pretty good. That's a good chunk to throw into retirement. Except, Jessica, if we pay those 3 kids and it's 22,000 per child, your 80 went down by 66,000. Your now final earned income number is only $18,000 times 25%. You're talking 4,500 that you can put into a set. So generally, if you're using tax strategies, SEPs and simples are things that we honestly stay away from, because they're based on that final net profit, earned income, whatever the IRS is going to tax. And we more often opt for your 401ks, right? And if you want to put away even bigger money, so that 30, 60,000, probably a 401k, maybe with a profit sharing plan, some little add-ons, maybe even a 401h. Has anyone heard of a 401h before? Nope. Okay.
What's that?
Yeah, let's talk about it. I love it. Thank you, Gary. Great question. Has anybody heard of an HSA? An HSA, a health savings account. Okay. Yeah. Yep. So an HSA is what's called a health savings account. Health savings accounts, the current maximum for a family, for husband and wife, is typically around $8,500. Okay. A 401h goes with a 401k plan. With a 401h, there is no maximum to how much you can put away for medical. So the H stands for health. It's like a 401k, which is retirement, and a 401h is for health. So another area to look at specifically in the retirement realm, good or bad, many of us have seen what has happened to our parents, right? Are they more likely to get cancer? What about dementia? What about, any other number, arthritis, right? What about any other number of medical issues that you can have when you're older? Some of us are lucky enough to have the genetics from our parents. They lived until 120 and then they just passed out when they were asleep, right? That was the end of it, right? Super healthy all their lives. So for many people, that HSA is a really good start. Fund that health savings account if you can, that $8,500 maximum for a joint couple, okay? But if you know that in your family has a history of cancers, dementia, any of these really expensive kind of medical issues, you may want to consider setting up a 401h, which would allow you to put even more into retirement medical, specifically medical, okay? Now, one of the things that I really like about the 401h is that at the moment, under the current law, at the time you reach 65, that 401h program now acts like normal retirement. You don't have to spend it on medical. So you could spend it on living expenses, whatever else you need in retirement, paying utility bills, like absolutely anything else. So if you have the cash to do it, combining a 401k plus a 401h plus profit sharing, it kind of depends on how much cash you really want to kind of stuff into these plans to give you the amount of cash you want at retirement. Okay. So any questions on this at this point?
Where do you get a
Um,
401?
So when you,
Oh, sorry, Gabriella, go ahead. Where do you get a what?
A 401h.
401h, absolutely. So generally a 401h will come with, so whoever sets up your 401k, typically, the financial advisors, or we do have we call them TPA, they're third-party administrators. A 401h tends to be a little bit more of a specialized plan. So a normal financial advisor might not know about it, but third-party administrators often do, right? So 401h, and if you guys talk to your people and you don't have anybody, reach out to Tax Goddess. We do. We can hook you up with, and any of the strategies we talk about, we have vendors, we have people that we work with for this front. So great question. Perfect.
Thank you.
My pleasure. Sorry, Garrett, go ahead.
well, the one I was interested in probably a year or so ago, because I'm trying to figure out what can I do, because I'm over 60 now, but that's Roth 401k.
Yep.
Hang on, I got some kind of message here from Zoom. Okay, sorry about that. Never sure what that was. And I think that was one you could put in like up to 60 something a year. What I forget, but as long as you were over 50. But the challenge for me like intellectually is this. A Roth I always equate to being using after-tax dollars. So it's not taxable when you pull it out, whereas a 401k is pre-tax dollars. So you do pay when you pull it out. I don't know how they can combine a 401k and a Roth at the same plan. It's probably a simple answer, but I didn't know what that was.
Absolutely. Let's talk through it. This is why you have a goddess here today, guys, right? Like let's sort it out. So yeah, every single one of these plans, right? And there's one more that we didn't cover, which is the one at the very bottom of the slide, the defined benefit plan. But every single one of these plans can either be traditional or they can be Roth, right? So you can have a 401k traditional, meaning when you put the money in, you get the tax deduction now at potentially a higher tax rate than you'll have in the future, okay? And then when you pull it out, you pay tax. So that's your traditional, and that works for an IRA, a 401k, a SEP, a simple, all of those pieces. Now you can also set up a Roth 401k or a Roth SEP or a Roth simple. And really, as we look at overarching financial planning, one of the biggest questions is, well, how much money, none of us does anybody in here have a crystal ball? Anybody?
Yeah.
No, I wish, right? None of us know what the tax rate's going to be. None of us. Trump has a lot of things he's saying, and I will not do any politics here, but, Trump has a lot of things he's saying. There's a lot of people that, we need to collect more tax. The rate has to go up. The general consensus is, even if in the short term we get smaller tax rates, we have a massive governmental deficit. At some point, somebody's going to collect tax on something, right? I mean, so the question becomes, and this is where really, really, if you aren't working with a financial advisor, because this is their job as a financial advisor, is to say, okay, this is all of your assets. You have a house that will be tax-free up to the first 250 or 500,000 if you're married or not married, right? You have this much in Roth IRA, you have this much in traditional 401k, all these different assets. And what they look at and what they look for is, okay, well, how much money do you need to spend when you hit retirement?
Hi, I just want to take a moment to thank you for watching a recording of the Monday Night Live class. Hope you're getting a lot out of it. I'm sure you will. I wanted to let you know that, you can come to Monday Night Live whenever you want, but you can also participate more with the team. Why don't you set up a call with me, a one-on-one strategy call? I can go over everything with you show you everything that we have to offer. For example, did you know that on our team, not only do you get your leads, we actually give you your own account on our lead gen system. So this puts you in control. You're not waiting on somebody to hand you leads. You get to pick the ones you want. Okay? Huge difference. We have 21 of our own proprietary marketing campaigns. They're all copyright protected. We're the only ones that can use them. Okay? The coaching is absolutely one-on-one. We got 3 coaches. We even have a 4th success coach that we have access to. Okay? One of left fewer than 100 in the world. Okay? One-on-one coaching. Right now the big problem is volume. We need more transactions. We need more inventory. I get it. Well, we know how to get it. Our team actually outproduces the national average by more than 2 to 1. So if you're struggling, don't do that anymore. If you're a solo agent, if you're a team, let's just talk. Smart entrepreneurs are always open to discussion. Learn what we have to offer, and then you can make an informed decision about staying where you are or moving on. You've got to decide, if you're not where you want to be, you've got to take action to get where you want to be. Let's see how we can help you do that. I look forward to talking to you. Click on the link, set up a call. And by the way, I'll see you on the next Monday Night Live.
Right. So question 1, have you paid off your mortgage? That's going to make a big difference when you hit retirement, right? If you still have a mortgage, you have an extra $1,000, $2,000, $300 or $3,000 payment every single month that your retirement funds are going to have to pay for. So, getting out of debt, always an important piece. I mean, period. Doesn't matter whether you're young or old or whatever, no debt is always a good thing generally, except for useful debt. We can talk about that, different topic. But understanding how much you're going to need when you get to actual retirement age. Okay. If you decide, many people, for example, I know some of you with kids, right? You may have had a bigger house when you were raising your children. Do you need that size house when you retire? We see this a lot. People will downsize, go to a smaller home, and that massively increases their retirement funds because they sold something much more valuable and now they're sitting on all this cash, right? That maybe they've invested or not, whatever they've done with the cash from that sale. So I think the question for me as a tax professional, the biggest question that we get is, well, should I do Roth or should I do traditional? The answer is it depends, right? Every single person has a different financial plan for the lifetime of them and for their spouse, right? It's a very different tax plan if you're single versus if you're married. So, yeah. Great question. Okay. So the one other thing I wanted to cover here before we move on to the completely tax-free forever kind of retirement is defined benefit plans. Okay. Now, I know I asked you guys about how much money you wanted to put in. We got 30, 60. So most of you are going to be covered by the 401k, the IRA, SEP Simple, kind of your more traditional level plans. With somebody who's looking to put away $100, $150, $200, $250,000 a year, the next step up is something called a defined benefit plan. Now, what a defined benefit, sometimes you might also hear the term cash balance plan. Okay, those two things are effectively interchangeable between defined benefit and cash balance. That type of plan is what's called a defined, oh my goodness, the first ones are defined contribution. The other side is the defined payout. Okay. And so what a defined benefit, what a defined benefit plan does is it says, okay, Lily is going to retire at the age of 65. And at 65, her company, does everybody remember the old days when we had pensions, right? You worked for a company for 30 years and then they gave you X amount as a pension to retire. Okay. Lily's going to work for her company. And the company has decided that when Lily retires, Lily is going to get $100,000 a year of pension. Pensions are defined benefit. It's how much you get when you retire. And what that allows you to do is, Lily, you look all of, 40 to me. I don't know. I'm terrible at guessing ages. So, and I won't do that. You're a woman on live broadcast. I won't do that to you. We're going to call you 40, Lily. Hopefully that's acceptable. Am I okay? Am my number? Yeah, we're good.
She's not 40. She's 40 and a half.
Off, that's what happens when I get my ages off, right? All right. So, Lily, if you're going to retire, if you're 40 and you're going to retire at 65, and you're going to live, you're a woman, you live longer. Generally, women live longer than men, right? And you're going to live until you're 90, okay? The company every single year has to put away enough money, plus the earnings and growth over time. It has to put away enough money to be able to ensure that you get your pension payout every single year until you die, okay? So the reason why these defined benefit plans are allowed to put so much money into them is because there's a defined payout. And if they don't meet the defined payout, there's all sorts of IRS problems and whatever, right? So these plans are really, really good if you have a huge amount of money and you're trying to stuff it somewhere, right? You don't want the taxation. You're trying to get the cash out of your pocket. It's into your future pocket, not your current pocket. Okay. All right. Perfect.
Okay.
All right. Dig it. So any questions on any of that? Nope. We're good. All right. Rockstar. I want to move to the tax-free for life version. Okay. Now, there's, when I talk to general audiences, okay, they hear the term life insurance and they freak out. You're selling me life insurance. Don't even talk about it. I don't want to know. Okay. Life insurance is good. Life insurance can be an extremely handy tool, right? Now, I think, because there have been previous in history, people selling bad things, bad policies, bad whatever. Okay. And I don't sell life insurance. Life insurance to me is a tool specifically for retirement. Okay. And for emergency funds. I'm going to throw this out here. Okay. The downside to using life insurance for retirement is that when you put the money in, it is not a tax deduction. Okay. So this acts like a Roth. You put the money in, but you do not get a tax deduction right now. Okay. What I love about it is that as you continue to put cash into the thing, right, the value, you get cash value, depending on how you structure the policy. Okay, there's a million different ways to do it, but the cash value goes up and you can use those funds for two reasons. Well, you can use them for any reason you want to, but the two we always suggest, one, as your emergency fund, right? Car broke down, AC broke down, you can take a loan against your insurance policies. So I'm all for that, right? Having flexibility of your money. The previous plans we talked about, so if I go backwards here a step, if you borrow from your defined benefit plan, the IRS could actually tax the entire thing. There goes your tax deduction, okay? There are limited circumstances under which you can borrow from a 401k. So buying a first home, significant medical expenses, there are limited circumstances, but I believe the current maximum you can borrow is $50,000. Okay. So one of the things that I really like about using life insurance specifically for retirement is that it also gives you the emergency fund. You can take a loan from your own policy for absolutely anything you want to. Anything, any reason, no questions asked, absolutely anything. Okay. Now, remember we talked about paying the kids a little while back, okay? If you start to build life insurance policies for those kids when they're 7, how much compounding do they have by the time they're 65? Andre's nodding. A lot.
58 years, yeah.
Yeah, it's a long time, okay? So one of the things that we recommend to parents is consider getting a compounding life insurance policy for the kids when they're young, okay? And just start putting dollars in there. $200 a month. Use the payroll that you're paying them, right? Use part of that $22,000 fund, $10,000 a year. Okay. When the kids are old enough to be responsible with the money, you can hand over that policy. The kids can use it to buy a first house, buy a couple rental properties, start a business, right? Generally young kids, I think one of my favorite examples that I've ever seen within our tax goddess clients, we had a parent did this, age 7. When the kid turned 18, he was supposed to go to college. Kid didn't want to do that. He had a business idea. Okay. No bank is going to give an 18-year-old kid a loan.
Right.
He went to his life insurance policy, got a $30,000 loan, started his business. This is now 3 years ago. Kid's making almost $400,000 a year at 21. So I'm not saying every kid is going to be amazing, okay, or every investment is going to be amazing, but having the flexibility to be able to do these things can really do a powerhouse, especially if you're trying to build family wealth, okay? And so for those of you that are 40 and Lily's age, right? If you don't have one of these things, go get it, right? The longer that compounding time, the better it generally is. Yeah. Now, I do like to bring up, because there's really two different versions here. They're the two that we normally use. You have infinite banking, which is typically a guaranteed rate of return, but it could depend on the market. Okay, so there are different policies for different things. It could go up. Generally, it doesn't go down below a certain level. So a minimum of 1% return or whatever it is on your money. Okay. The other one, and infinite banking is fantastic for people that are looking for that emergency fund, right? Where I may need this money. I don't know if I'm going to need this money, right? So I want flexibility. I want options. Okay. If you know that you do not need the cash, okay, so if you've already done a defined benefit plan, you've already stuffed as much money into retirement as you want to, you're still sitting on some cash, you're not sure what to do with it, premium financing is a way to leverage, just like buying a house with a mortgage, okay? This is buying an insurance policy with a mortgage, which basically gives you a much higher return on your investment because you're leveraging, but you can't touch it for 15 years. So don't use premium financing if you need emergency fund access. Okay. Okay. All right. Any questions on this side? Nope. Okay. Okay. All right.
Okay.
So let's keep rolling. Let's see. I want to see what other options. This is an example, just a calculated example of the difference between the infinite banking, which would be the self-funded, the first column, and the leveraging side. You can see, depending on age, depending on what you're doing, same amount of premiums go in, $60,000 in a year. The outcome is almost 4 times as much for the end. So it's actually very powerful, but you just can't touch it for 15 years, which kind of catches people if something happens. So you have to have a separate emergency account for this. Okay. All right. So let's go play with more strategies. Give me a second here. I want to see where we're going. You know what? I'm going to bring this one up specifically because it's that time of year, guys. Okay. When you get your 1099, right? Many of you get 1099s. Is that right? Or are you guys all 1099s? I got some 1099s. Yep. Okay. All right. When you get your 1099, please double check that dollar amount. We have seen over the past 4, 5, 6 years, there have been so many changes in the ways that 1099 rules are supposed to happen. A lot of organizations are not properly reporting the 1099. So please double check it. Okay. That at least gives you an opportunity to go back to the organization that's paying you, right, to make sure that you've got the right dollar amount. What we've seen is reimbursements in there that shouldn't have been in there. We've seen, and I don't think you guys are being paid by Stripe or PayPal or anything else. We're seeing other 1099s show up for like personal transfers, family and friends transfers, and you're getting a 1099 for it. So just watch those 1099s. It's definitely this time of year. It's always January 31st when you get them. So watch that for me. With your business, this is probably one of everybody's favorite slides. Does anybody in here go out to eat ever? Yeah, we got a few. I'm in this category. Okay. One of the things most people don't realize is that there's actually 3 different types of meals and entertainment. Not entertainment, I'm sorry, meals. Okay, there's 3 different types. There's 50% meals, there's 100% meals, and there's a third one I didn't even add here, which is travel meals. Okay, Gary, you mentioned many years ago, you were traveling all over the place. Okay. Does anybody else do that level of travel? Andre, maybe little bit of travel. Okay. If anybody in the room does a significant amount of travel, like you're on the road 180 days or more a year, okay, you're going to want to deep dive into the travel meals. Okay. And just to give you an example, one of my favorite examples, if you're traveling in New York City, so you're leaving wherever you are, you're going to Manhattan. Okay. and you decide you're going to get a slice of pizza for $7 from the pizza cart, you can actually deduct up to $35, even though you only spent $7. So it's called per diem travel. So if anybody in here is doing significant travel, reach out, look into per diem travel. The travel expenses can be huge. For those of us that are stuck at home, as everybody else, I presume everybody else doesn't travel that much, okay? I want you to break up your meals expense between 100% meals and 50% meals, okay? Now, if anybody wants to take a screenshot of this one particularly, the IRS really changes these almost every single year as to which one's deductible, which one isn't deductible, and at what level is it deductible, okay? Do any of you have an office, a home office, or an actual office that you go to? Yeah? Okay. If your kids and your spouse are employees, you now have other people that are in the office that you may need to provide coffee, snacks, beverages provided in the office, right? If the kids are sweeping the floor, okay? At least you can get a 50% write-off for that, okay? Now, how many of you do events with your clients? Does anybody ever invite their client to their home or to their office? Gary, we got one. Okay. Client events, meals during events, okay? Meals offered to the public. If you ever do an educational, like let's say you do a seminar at your home or at your office and you invite people in, okay? These types of food are 100%. So if you're buying the party platter, the trays, you know, this kind of thing. So depending on how much you do, this can actually add up fairly significantly, right? So make sure that you're categorizing your meals either to the 50% category or the 100% category so that your CPA knows where to put them. Okay? Okay. Now I know we only have 2 minutes left. This went by really fast, okay? There's one strategy that I absolutely want to make sure that you guys have, and it's this one. This is probably my favorite strategy in the entire deck, okay? This is called the master's exemption. How many of you own your home? So having a mortgage is okay, but like rent versus owning. How many? Okay, we got one for Gabriella, we got Andre. Okay, so we got a few here that own your home. This one relates to people, Christine, thank you. This one relates to people that own their home. Okay, now this can be your primary residence. It could be maybe a second home, like if you have a cabin on the lake or something, okay? Your business, if you have a business, and Andre, I'll pick on you because you told me you have an S Corp, okay? Your business can pay you, the person, rent to use your personal space as an office space. Now, I'm not talking about home office, okay? So this is not every day using your home office. We talked just a few minutes ago about potentially doing like webinars or seminars, having people come to your home to do an event, education, maybe have other team members come to your home, okay? Your business is allowed to pay you personally rent up to 14 events per year at whatever the fair market value is for the space that you're renting, okay? So I want to give you a couple of examples here. This can be really powerful. I just moved into this house, the house you currently see me sitting in, about 2.5 years ago, all right? My old house was in a place called Old Town Scottsdale. So I'm in Arizona. It was in Old Town Scottsdale. It's kind of a hopping little part of town, okay? And the hotels that are near there are pretty expensive. So if I wanted to hold a conference with my clients at my home, I would call the conference centers, call the hotels and say, okay, listen, I'm going to rent out about 800 square feet to hold this meeting, right? Maybe it's a mastermind, something like that. And I need to know that if I came to your hotel and I said, okay, I want to rent 800 square feet of your space, how much would it cost me to rent 800 square feet of space for a 1 day, half day, you know, whatever it is, whatever the event is, okay? Now, in Old Town Scottsdale, that rent, so these are my numbers, right? I called around, did the research. That rent came in at about $3,500 per event, okay? Which means that I can hold 14 of those per year and my business gets a write-off of $49,000. Now, normally when you pay somebody something, if your business because your business is paying you to have rent in your home, right? Normally you have to pick up that income, right? Because the business paid you to do something for it, paid you rent. But because of this special rule, it's called the Augusta rule. Sometimes you hear it the master's exemption. Has anybody connected those two? Masters,
Yeah.
Augusta. Yeah, anybody know what that's from, right? It's the golf tournament. Okay. This law was written specifically by the congressmen and senators who own homes in Augusta, Georgia, so that they could collect rents and not pay tax on it. And one of the things that I love about being an American citizen is if the law exists, it applies to Lily and it applies to Andre and it applies to Gabriella. It applies to all of us, right? Because the law is there. Now, the second number that you see, when I moved into my new home, I moved into a pretty nice area of town, right? And just so happened that there's a Trump hotel and a W hotel almost within like a 5-minute drive of my location. My rent went through the roof, as you can see, okay? So a lot of this is very much based on location. So be very careful when you do this. You know, the lowest that I've ever seen is about $500 for an event, okay? The highest I have seen year to date or life to date, $19,700 per event for Manhattan. That was 100 square feet. 100 square feet in Manhattan. It was basically 3 people doing this in a room, okay? So make sure you're doing, if you're going to use this one, make sure you're doing your research. This is definitely one of those cross those T's, dot those I's kind of thing, okay? Not all CPAs will allow you to use this strategy. So definitely talk to your CPA, the person actually filing your tax return, before you attempt to use the strategy, and either make one of 2 decisions. Either they say, yes, I like it, I love it, Andre, we're doing it, here's the fair market value, we're going to use it. Or they say, no, absolutely not under any circumstances. You might be looking for a new CPA, right? Because this is definitely legal. This is probably, for those of you on the aggression scale, this is probably a level 6 on the aggression scale. Okay. Home owned by the trust, that's totally fine. Yeah, because as long as you own the trust, it depends on whether it's revocable or irrevocable on that front. Plus, it's 14 days. So for example, if you had 2 events on the same day, that's 1 day. It's 14 days. Okay. And another really side note, cool thing about this, for those of you that might have like a primary home and then like a cabin or something, right? Two homes, you can do this on both properties. It's 14 days per property, right? So a lot of people will actually buy a second home by having their business rent the second home for masterminds once a month, you know, the cabin in the woods or whatever, and that pays for your mortgage, right? So there's some cool ways to use this one in particular. Blessed, I'm so sorry. If it's an irrevocable trust, it's not your name. You don't own it. The trust owns it. So yeah, if it was a revocable trust, you'd be good, but irrevocable won't work for you. Sorry. Good question. Good question. Okay. So guys, I know I've overtalked. It's 6:05. I'm so sorry. I've completely overtalked. What questions can I answer for you guys? Oh, thank you. What question can I answer for you guys?
You guys take advantage of this while you have it. I mean, if he's one of a very rare breed, like one of 15 people. Seriously, that
Somebody's
unique.
asking if it's 14 days or 14 events. So
14
can
days.
you have a 3-day event count as 1 event, or is that 3 events?
3 days. That'll count as 3 days.
So
Yeah, the
each event-
IRS is very
okay.
specific. It's days, specifically days. Yeah. And so, you know, you want to be careful with this. I had great question. Yeah, 3-day event is not 1 event. It's 3 days. I had one of our clients is one of the top master iron forging people. I wish I knew how they call themselves, but he's an iron forger. He makes knives and things. He had invited a Japanese master to come and stay with him at his home, and it pushed him over the 14 days. If you go even to 15 days, all 15 days become taxable. So do not go over 14 days. 14 is the maximum. Do not go over 14. Okay. Okay. Love it. Dig it.
Wow. As far as setting up some of the retirement strategies, we have to pay by April 15th
Yes.
the prior year. So April 15th, 2025, we have to come clean for 2024.
Yeah.
But between January 1st and April 15th, can we implement some of these strategies that would apply to 2024? Or is that we can? Okay.
100%.
Wow.
Now, guys, this is where it's really kind of cool. So your basic plans, right? So your traditional IRA, your Roth IRA, you're allowed to do those until April 15th for the previous year. Okay. So you can absolutely do that for the previous year. Now, some of the larger plans, right? Your 401ks typically have to be set up by December 31st. So if you didn't have it already set up, you might have missed that. Cash balance plans, if you want to go bigger, cash balance plans, you can set up and fund by October 15th or September 15th. Like Andre, you're an S Corp, so your deadline is September 15th plus extensions, right? But you can fund a cash balance plan all the way up until September 15th of 2025 and still take that deduction against 2024's income. So you do have some really big, broad timelines there, depending on the type of plan that you're going to implement.
Yeah.
Great question.
Now, the cash balance, is that also one that can be either
Roth or traditional?
pre-tax or post? Gotcha.
Yep.
Okay. And
Yep.
what's the limit on the cash balance? I don't know if it varies.
It
I
varies
can't remember.
because it depends. Are you 40 years old like Lily, or are you, I don't know, 80 years old like me? I don't know. It completely depends on how close you are to that retirement age and how long the company, how much money the company has to put in to make you hit whatever the defined benefit or cash balance is at that age. So yeah, it's very dependent.
So we determine the benefit, the
You got
final,
it.
I guess. Yeah.
Yep, you want
Wow.
100,000 a year, you want 500,000 a year, and that will depend on how much cash you put in. Now, there certainly are some limits. There was some abuse. No big surprise, guys, right? If there's a great strategy, somebody's going to abuse it. So there are some limits that you can't put in typically more than whatever your net worth is times 2 or 3. So you cannot say, listen, my net worth is $1 million, but I want to have 50 million in retirement. They won't let you do that. So there are some issues there. But yeah, this is where that TPA, the third party administrator, comes in, because they have actuaries, they run through all of this stuff based on your age, your family, beneficiaries, all that kind of jazz. So,
well, something like that, I would definitely make pre-tax, because it gives you, we'll get to everybody's different. That's the thing.
And that's really why the answer in the tax world is it depends. Who are you? What do you want? What are you looking for? We've seen cases where somebody will set up a cash balance or a 401k. They'll do 50% Roth and 50% traditional. So you can even split it.
Yeah.
Right. So it's really dependent on what you're looking for.
Yeah.
Yeah.
Okay. I can't remember if I ever asked you this before. Have you ever, there's something floating around out there, and I forget the entire name of it. It's like it's irrevocable, non-grantor, spendthrift,
yeah, some of the trust stuff.
It's got some other stuff involved too, but it came out probably 20 years ago.
Yeah.
And maybe people don't understand it, but people are getting audited, and the IRS is saying you can't do that. But it uses IRS code 643. And what it is, it's like a business contract as opposed to a traditional trust law. It's using a trust, but it's a business contract you have with the trust. So it manages everything in it. Everything that stays in there, as long as it stays within the body of the trust, the corpus of the trust, you could sell a 100-unit building, for example, and buy a 200-unit building, but you don't have to. It's not like a 1031 exchange where you got 45 days to identify, 180 to close. There is no time limit. It doesn't have to be like kind. You can cash it on one investment and invest in another, as long as you don't actually personally touch the money. It doesn't come outside the trust. It stays in it. You're perpetually deferring taxes. And there's some other features, but I'm trying to find people that have used it successfully, because I've only come across a tax account. He said 2 people get audited, and the IRS is like, we don't think so.
Yeah. I guess because certainly I've heard of them, right? And it's my job as a strategist to vet strategies, right? So I think one of the most, if anybody ever hears this term, you own everything but control nothing. That's one of the marketing terms that they use for what you're talking about, okay? Because it sounds great. I own everything. I control, I'm sorry, own nothing, control everything. But you know, I control everything, but I don't own anything, and therefore I don't pay tax. Uh-huh. Nope. Right.
Yeah.
And this is why the IRS is busting it down. You know, one of the warnings that I will give you guys, there are, we cover, and we were only able to cover 4 or 5 strategies today, guys, right? We look at over 1,800 strategies for every single client. Okay. And those are the legal ones, right? I've probably seen another 1,000 that are fly by night and don't touch it with a 10-foot pole, and you know, this kind of thing. So I think that, you know, the old adages hold true. If it's too good to be true, it probably is. Okay, so why, right? What's going on? And you know, the IRS has done, I mean, you know, not that I'm a fan of the IRS, but they've done a pretty good job of cracking down on what I call the fly-by-night companies, right? Yeah, give us all your money and do this thing, and we'll save you all these taxes. And you do that, and then 3 years later, they're gone, nowhere to be found, and you're stuck holding the bill with the IRS. It's, you know, so really, when you're looking at strategies, when you're looking at these kinds of things, you want to be with a firm, with somebody, with the person, whatever, you know, check into that history. Do your due diligence, right? How long have they been around? How many times have they been audited? What, you know, what kinds of strategies do they use? Does it feel right? And this kind of goes a little bit to that aggression scale, right? You know, I will go up to an 8 as a strategist, right? Red and orange. I always tell people, red and orange do not look good together. I'm not going to jail. Okay. Like that's not working for me. I'll go to an 8. But if you tell me, I know somebody had said, Gabriella, you said you're a 2. If Gabriella comes into my office and says, I'm a 2, okay, then we're not going to use this, and this, right? We're only going to use 0, -4 through 2. Like those are the strategies that we're going to be using. And you know, the other side of this, I think it's just really, really important that when you're looking at a strategist, or when you're looking at strategies just in general, make sure that you're working with the strategies that work for you, both from an income size, right? So for example, like we talked about those retirement plans, unless you want to put away 150,000, do not get sucked into a cash balance plan, because you're not going to use all the features of it. Go with the 401k that's been around longer, that can give you what you need, that, you know, it's better suited for you. And I think that's one of the places people kind of get themselves in trouble. You know, they want all the features and all the functions, but they don't need all the features and all the functions. So sometimes you have to layer things over time to really get to where you want to be. So.
Yeah. Okay. Hey guys, any questions? I want to be respectful to Shauna's time too. It's supper time down there in beautiful sunny Arizona. Let me check the chat box here.
Absolutely. Yeah, and so guys, you know, certainly I would say if you have any questions or whatever, you're welcome to send an email. I would say through Gary, he'll coagulate all those emails, send us over an email. Oh, thanks, Jessica. Happy to be here tonight, guys.
Yeah.
You know, we can get everything through Gary. We'll try and get you the answers as much as we can. And you know, if you, your clients, if anybody with tax goddess particularly, we work with clients that are paying at least $100,000 a year in taxes. Okay. So if you have anybody in that range, we'd be happy to help. If you're not quite there yet, but you still want strategy, we do have referrals to other people that do strategies, right? So let us know. We're happy to try to help. Okay.
Awesome. If you guys wouldn't mind, give Sean a big round of applause, pat on the back, or you know, handshake. Yeah, I definitely feel lucky to have you here tonight again, and for a second time too, by the way. That's pretty awesome, you know.
My pleasure. Well, you always bring the best crowd. You guys ask the best questions, so thank you so much. I appreciate being here.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.